SoFi stock, what an absolutely incredible move. That stock is up over 19 percentage points here today. I do hope the gains last. This one has flirted with going, $9, $10 a few times recently, and then it would fall back to $6 to $7. So let's hope this time the gains stick. So I want to go ahead and at the top of this video, I want to speak about SoFi. We're going to react to 4 videos in this one here today. First off, we're going to talk about SoFi since their earnings came out. I want to kind of share my opinions, perspectives there, and kind of the story that is really changing for the better, it seems like, for SoFi. Then we're going to go ahead and get into this one. This is a little 2-minute clip. Tesla begins China Cybertruck tour in 8 cities. That should be interesting. So looking forward to getting in that one. Then we're going to react to this one. Investors can expect 3 rate cuts in the second half of 2024, says Roger Ferguson. He's a former Fed vice chairman. So I think he's an important person to pay attention to if you want to know what the Federal Reserve is actually likely going to do this year, okay? And then last video up here is Ed Yardeni talking about his opinions on what the Fed should do here, okay? So appreciate y'all joining me as always. All I need from you is to smash that like button and also make sure you're subscribed to the channel. That's it. Did you smash a like? Are you subscribed? That's it, folks. Other than that, let's get rolling with this. If you're looking to join a private stock group, if you need help understanding how to value stocks, how to figure out if stocks are overvalued or undervalued, balance sheets, income statements, all that sorts of stuff, I have all courses in my private stock group that you get access to. So if you want access to that, pin comment down there to apply to join us in there. Alrighty, guys, let's get into this.
Digits on those strong results, almost up 23% right now. CEO Anthony Noto joins us. Anthony, thanks for being here. Big quarter for you all. Profitable one, record revenue across the 3 businesses. Solid, profitable outlook as well. What are some of the key drivers that you think led to these results?
Well, Leslie, thank you for having me on. I'd say the strategy overall has really come into play and delivered exceptional results for the quarter. 6 years ago, we embarked on this very ambitious strategy to be a one-stop shop for all your financial services needs. When I joined the company in February 2018, we were primarily just a lender in 2 products. Today, we offer not just 4 types of loans, including home loans, but we also offer SoFi Money, which is a modern checking and savings account, SoFi Invest, SoFi credit card, insurance products, and we also power 140 million accounts across the fintech industry through our technology platform that we outsource to our partners. This quarter really reflects the fact that the financial services segment is now profitable and growing quite meaningfully. The tech platform business is also profitable with accelerating growth. And that's really the drivers of growth going in 2024 and less so the lending pieces. So it was a combination of that strategy over the last 6 years being invested in and then coming to fruition in 2023 with record revenue of over $2 billion and record EBITDA and actually hitting our long-term EBITDA margins at 30%. And as you mentioned, GAAP profitability for the first time, which will sustain in 2024.
Yeah, and of course.
So you might look at SoFi here and you might ask yourself, what's the difference between SoFi and a traditional bank? Because both are profitable now. You heard him just go through the lines of business they're in. Guess what? Most of those are same businesses that, let's say, JP Morgan Chase would be in, or Bank of America, or some of those companies, right? So you might say, what's the difference, right? I'll tell you, I think there's 2 key differences, in my personal opinion, in regards to SoFi versus a traditional bank, okay? One should be obvious, and that is growth rates, right? SoFi's growth rates are so far exceeding an average bank out there, right? And so that makes them much more exciting and compelling from that standpoint, right? And secondly, I would say tech, right? So much more focused on tech overall than traditional financial institutions or banks in general. And so I think that's where the 2 differentiations come from. And so for SoFi, they're going to command a much bigger valuation in terms of, let's say, a forward P. If you're trying to judge it on a forward P basis, they should command a much larger forward PE than, let's say, I don't know, like a traditional Wells Fargo or Bank of America or JP Morgan or somebody like that, in my personal opinion overall. Okay. All right. So let's keep rolling with this.
This all comes against a macroeconomic backdrop that for a lot of lenders remains uncertain. And you have a pretty conservative outlook for 2024, baking in a 5% unemployment rate, 4 rate cuts, which is, of course, fewer than the market is pricing in. So
wait a minute. Hold your horses. 5% unemployment rate? That's interesting. SoFi is expecting a 5% unemployment rate. If I was a SoFi shareholder, I'd actually feel really comfortable that my CEO is being very cautious like that, right? I was a JP Morgan shareholder for quite a while, and I always appreciate Jamie Dimon. Usually was a little more, let's call it keeping it safe. And so I appreciate that. That's good.
In terms of customer spending trends, portfolio quality, that is helping to inform your outlook for 2024?
Yeah, as you mentioned, we did take a very conservative view on the lending part of the business for 24. We are expecting 75% year-over-year revenue growth in our financial services segment and 20% year-over-year revenue growth in a tech platform, and really no growth in.
Yeah, those growth rates are insane. I mean, let's just be honest. Like pretty much no bank is touching those growth rates, right? That's
because of that conservative view that we're taking. We do expect credit to normalize. We're seeing those trends across the industry as well as at Sofi, and so we're taking a very cautious view there. In terms of underlying spending trends within Sofi Money, we had $1.6 billion of point-of-sale debit spending in the quarter. That's annualized at about $6 billion. It's up 3x from a year ago. We're seeing strength within existing accounts, but we're also adding new accounts, so it could be a little bit misleading. In addition to that, we have been observers of the broader market dynamics. We've seen some levels of liquidity dry up in certain markets. In addition to that, the largest banks have seen an increase relative to 7 and 10-year highs in write-offs, delinquencies, and then the provisions for losses of one of the largest banks were up 50% sequentially. So we're really bullish about our financial services segment, which is growing quite well, 75% for next year, and tech platform, but conservative on the lending side.
Hey, Anthony, some of the macro stuff that got commentary in the earnings last week was about real wage growth.
Before we go any further here, let me answer this question, right? Because it might be on people's mind. Are these gains going to stick? The gains of today, right, in the stock? My opinion is, I would say this time it is very likely the gains stick for Sofi. Now that they are truly profitable and now they're expected to stay profitable, that they came in with that big revenue beat, I think there's a high probability the gains stick this time and the stock doesn't go back down to $6 to $7. So it's always possible, right? It's a big weakness in the market or something like that. But I think there's a pretty decent probability that this time the gains stick and that baby rolls higher from here. So we'll see how all that shakes out. But that's kind of at least my 2 cents on the stock price movement.
Rising again after 2 years of shrink.
Put it this way, I'd be shocked if this stock hits a 6 again ever. I'd be shocked at this point in time.
Is that starting to make itself felt within the metrics?
Possible. I'd just be shocked if it happened.
We're not actually seeing an impact on spending. We are obviously seeing a normalization of credit back to pre-COVID levels. So that's where it's showing up on the spending side. That is still strong, but the credit side across the industry as well as at Sofi is definitely normalizing, which is why we're taking a conservative view. The unique thing for Sofi is that in 24, 50% of our revenue will be from technology platform revenue and financial services, and 50% from lending. In previous years, it was as high as 80%. So we've gained scale and profitability in those two segments just in the right time as we enter 2024 and the concerns on the credit side.
Yeah, I mean, just very impressed overall there in regards to Sofi. I mean, just makes me want to buy the stock. I'll just be quite honest with you guys, okay? Next one up here, Tesla begins China Cybertruck tour in 8 cities. Ooh, what's going on here?
Truck tour in China, and it's been getting a lot of social media buzz there ahead of this trip. Our Eunice Yoon joins us live from Beijing with more on what's at stake for Tesla. Hi, Eunice.
Hey, Mike. Well, the Cybertruck is on display at the Tesla store behind me. This weekend, the company started showcasing the futuristic new vehicle in 8 Chinese cities, including here in Beijing. Now,
the Bears haven't even factored in how big of a hit Cybertruck's going to be in China. They haven't even factored it in yet. Oh,
continues
so
to be a fan favorite among EV drivers here, despite the fierce competition by local brands. One of the criticisms, though, of Tesla is that it doesn't refresh its models quickly enough, especially when compared to some of its Chinese rivals. Now, for this Cybertruck, Tesla has not officially announced that the Cybertruck would come here to China. In fact, Elon Musk has gone on record as to say that it's going to be difficult. And one of the issues has been the regulatory environment, especially around trucks. But one point that was really interesting and picked up upon by a lot of the fans is that the name of the Cybertruck in Chinese avoids the word truck. So that's seen as a way for Tesla perhaps to eventually launch the Cybertruck here. Guys?
Yeah, see, this is just so huge because, Cybertruck could be massive in China. Absolutely massive. China's not really, people don't really think about China as like a truck place. But I'm just telling you, that is so up their alley. You have no clue. Like, that is so perfectly fit for China in terms of the way the vehicle looks, how different it is. People will eat that thing up. And everybody's just thinking about the United States opportunity, which we know Tesla can literally make as many Cybertrucks as they can and sell them all, right? So whether it's 100K, 200K, 300K a year, whatever the number is, right? But like, people haven't even factored in like how big of a hit this could be in China. And I'm like, it could be much larger long term, if we're thinking 5-7 years out, than it is in the United States of America.
I wonder, aside from just sort of the names and what the implications are, in the U.S., of course, pickup truck's the most popular type of vehicle. What's the case in China in terms of that ready kind of appetite for something that, even vaguely looks like a pickup truck?
Right. Well, it's interesting because here you really can't get a pickup truck, or if you do, you're not able to drive into the city, like into some of the kind of more packed areas. So there are a lot of regulations around it. And that's why it's interesting that in the name, people love to see these big cars. They love driving them. That's what they were talking about, is that everyone's impressed by the size. They love the look. They were talking about how it looks like an armored vehicle. People loved it. But the regulations are such that they don't allow what would be considered a pickup truck into the kind of more packed parts of the city. So the fact that it was called an urban traveling wagon, maybe not so catchy, but maybe it could get you around some of the regulations.
That's hilarious. As I always say, Elon and the team, they'll figure it out. Have trust. They'll figure it out. Next up here, Federal Reserve former Vice Chairman Roger Ferguson.
Vice Chairman, former TIA President and CEO, and a CNBC contributor as well. He's got a lot of things on his resume. Roger, it's great to see you. Do you have a new view?
Nice to see you, Andrew.
You got a new view, given all the numbers that we've seen thus far? Is this pushing things out? How quickly is Jay Powell really going to be lowering interest rates in your world?
In my world, it's still the second half of the year. And for me, that's not a new view. I think what we've seen is an economy that is still strong. The last GDP print, I think, surprised a little bit. The good news is the last PCE print suggested that the disinflation process is underway. But there are some concerns that a few people might have. Some of the turmoil in the Mideast might lead to pick up slightly in goods inflation. And the service sector still is a little hot. So I think second half of the year still is my bet at this stage. And I think the market is starting to come at least in that direction.
And is that
do I agree with him? And the answer to that is yes, I do agree with him. I'm expecting second half more likely than first half. They'll put it like that.
3-cut situation, a 2-cut situation, a 1-cut situation? What are you thinking?
It's also about the
I'm
size.
thinking may well be 3. The issue, obviously, is fortunately, inflation looks like it is moving in the right direction. They have no need to stay in restrictive territory in the real rate, the nominal rate minus inflation. And so, I think squeezing 3 in the second part of the year is still my base case. Certainly not more than that, possibly a little less if things slow down. Okay. So that's where my head is right now, and that's not a dramatic change for me.
Okay, you can answer this question with more authority than practically anybody we've had on the broadcast recently. So I want you to end this debate for us, if you could, or maybe we'll just continue it. You know where I'm going with this? So we have a lot of people who come on who say,
I'll let you go.
Who say, you know what? It's very difficult for the Fed to start lowering interest rates in a presidential election year as you get closer to the election itself. And that weighs on everybody. It actually is part of the conversation. And therefore, they may not do these things, or they're going to want to do these things before that. Take us, you had the job. Take us inside the room. Does the presidential election become part of the actual discussion itself?
I've never been in the room when the presidential election was part of the discussion itself. I can't speak to what's in everyone's mind, obviously. But think about it. If they cut early and it proves to be the wrong thing to do, they'll find themselves raising rates in an election. if they delay, they find themselves losing the possibility of getting, the soft landing that looks like it's within grasp. At the end of the day, following the economics is the only thing that matters, because that's how you get to the best outcome. And if the politics get in the way of that, then someone's going to look bad. And so I think the logic of the case has got to be follow the economics, carry out your plan, because that's the only way to actually stay out of harm's way.
Yeah, so there's a thought process, okay, to go to the political side. There's a thought process that, okay, T-Man isn't in love, obviously, with Powell. And I believe he's even made comments in the past that he would potentially fire Powell. So there's a belief that maybe Powell wants B-Man and not T-Man to be in office again, right? And for another 4 years. So the thought process is they cut to try to make the economy look better going into the election, so then B-Man's president again, right? So that could potentially be something positive in the short term there if you want that. But here's the problem. Let's say they cut, too much too fast, inflation comes back, they got to come in with rates again. All of a sudden you have a super deep recession in 25 or 26 or something like that, or 27 even, right? Well, then you just killed the next election in terms of Dems getting in, right? And you're also going to affect smaller elections outside of the presidential election as well. And so that could create a whole dilemma for you, a massive dilemma. So, that's kind of like, maybe you could have a little short-term gain, but then you might get long-term pain, right? The Fed's got to, at the end of the day, make the best decision that they feel, regardless of who you want in office or not in office, right? And so, that's, you got to factor that in.
Roger, Nick Timmeros at the Wall Street Journal had an article that hit yesterday that raised a lot of questions about what we might anticipate the language change could potentially be coming out of this meeting this week. That while he doesn't think they're going to be cutting rates this week because the economy's been pretty steadily growing, it does raise this question about whether they're going to ditch the whole idea about the most likely scenario being that rates would rise from here. You think that is a reasonable way of looking at things, kind of easing your way out of that to open up the door for potential interest rate cuts?
I think they're going to have to acknowledge that inflation is coming down closer and closer to the 2% target. Consequently, that gives them some room to move rates lower. So they're, I think, going to try to guide as softly as they can towards the second half of the year cutting. They certainly want to keep in place at least, the 50-50 in March and try not to, raise expectations of an earlier cut. So it's going to be walking a bit of a fine line by admitting that, yes,
yeah, I was going to say it's hard to not raise expectations
cutting.
of the March really happening without signaling when you're signaling something like this.
I think that's right. So recognize what they're going to. I think they're going to try to hint at a delay, but I think in the conversation, Chair Powell is going to talk about the SEP and other things that seem to put that delay, that cut towards the second half of the year. But it's going to be a tightrope for him.
Yeah, fair play by Roger Ferguson there, okay? All right, last one up here. Ed Yardeni. The Fed should hold off on any easing at all. Okay.
Debating what the Fed's going to do. We've also been debating how some of these earnings are going to turn out, though I think people are a little more optimistic than they had been 2 weeks ago. Where are you?
Well, I've been consistently optimistic, actually, about this bull market that started October 27th of 2022. So far, so good. I think we're getting a little bit stretched. Need to have some consolidation. But earnings, I think, are going to be fine, especially for the quality names that Mike just went through. And at the same time, we've got some other issues that are becoming maybe more relevant, and that's the ongoing conflict in the Middle East. And, of course, the Fed has to deal with these issues just the way investors do.
So he says, earnings for a lot of the big guys should be just fine. My opinion is I don't think just fine. I think really, really good. If we're talking about most of the Magnificent Seven, outside of maybe Tesla and Apple, I think phenomenal. I did a full video on the main channel yesterday that went into my in-depth thoughts on Meta's earnings coming up, Amazon, how much I think they'll beat or miss on, and all those sorts of things. So if you didn't get to check that out yesterday on the main channel, definitely check out that video. You'll enjoy it.
Your optimism, layer on the Middle East. It seems like the market is taking it all in stride. Should it be?
Yeah, I think that's absolutely correct. I keep watching the price of oil, and it has come up somewhat. But there must be a tremendous amount of oil out there available through all sorts of different channels. At the same time, it's important to realize that this notion that the U.S. had to have a recession to bring inflation down turns out to be incorrect. What really happened is China has had a recession, a property-led recession, and Europe's been in a recession, so the demand for oil has been weak. And so that's offset some of these Middle Eastern concerns.
When you think about what the Fed is going to do, how important is your optimistic take to the idea that the Fed is going to cut potentially in March? Is March too early?
Yeah, I think I'm a contrarian on this issue. The markets have been expecting 4, 5, 6, maybe 7 cuts this year, and sooner rather than later. I think the markets have backed off a bit on that. But I actually would like the Fed to hold off easing at all. I think the Fed has actually not only tightened, but actually normalized. Interest rates are back to where they were before the great financial crisis. Investors are finally getting an appropriate return in the money markets and in the bond market. And the economy has demonstrated that it's resilient and it can live with them. So I'd like to see, you discussed capital markets in a previous report here. I'd like to see the capital markets work more efficiently and let the bond market determine where capital should go.
So you think you just leave them as is, and the market will still go up at this point?
Well, I think if you leave them as is, and it's clear that one of the reasons for that is because the economy is doing well and earnings are coming in strong, then I think it's a good trade-off. But I don't think there's any rush for the Fed to ease right away here. They got the risk of the Middle East creating a 1970s scenario to 2 energy shocks. Right. And then if they ease and become too dovish, they'll get a 1990 scenario, which is irrational exuberance. So I think the smartest course for them to avoid these kind of risks on the tail risks is to, in fact, do nothing.
I'm loath to ask.
I like that as well. And my thought process is, hey, if you see unemployment really start to tick up in any meaningful way, okay, start your cutting cycle, right? Because then it's like, okay, we could be going into recession, so let's get ready to go here, right? But I would, if I was a Fed, you kind of want to try to hold off as long as you possibly can in regards to that, right? Because one, you don't want to spike inflation again and then have to come in when the economy is in a much weaker state at that point in time with more, rate hikes. That would be devastating, because then you're talking about a way deeper, darker recession at that point in time, right? So, make sure inflation is done, right? If you can wait that long, why not? Like why not at that point, right? And as somebody that, if you have money in a savings account right now or treasuries, it's phenomenal finally be able to get a decent return. I mean, up until the last really 15 years, throughout history, it was never a normal thing to be able to get like a 0% or 1% or 2% return on, money. And now we can actually get 4 to 5% between savings account and treasuries. That's magical. We have never really seen that, at least in my adult lifetime. My adult lifetime started in 2008, right? I was about 18 years old. So my adult lifetime started. I mean, my entire adult lifetime until really the past year, you weren't ever able to get anything on some cash laying around in either treasuries or savings account. It's beautiful to actually finally have some of that, right? And so, I'm kind of with Ed Yardeni. And by the way, like he puts there, we're kind of just back to normal, normally where we should be. It's not normal to have interest rates at 1% or under 1%. That's not normal at all. That usually means you're in, harder economic times.
It's just a cliche of a question at this point, but are the Magnificent Seven still magnificent?
Some, yes, some not so much. It's starting to be a little bit of a more specific story for each individual stock. Tesla has obviously some issues right now, but maybe it's not 7 anymore.
So what is it, and what would you buy and what wouldn't you touch?
Ooh.
Well, we did see a nice rebound since late October of last year in the small cap and mid cap stocks. which made a great deal of sense to me because these are really cheap stocks compared to the S&P 500. And there are lots of good small and mid-sized companies that should do well in an environment where for the third year in a row, we're not going to have a recession, as has been widely anticipated. So I think that's a good area to be. I would stick with technology. I would stick with financials. I think energy has to be overweighted as a hedge against the Middle East craziness.
Yeah, Google's okay. Microsoft's okay. Meta, Amazon are buys. Nvidia, actually a buy, surprisingly enough. So yeah, there's certainly some opportunities there. And then in small caps, we know there's a lot of opportunities out there. Okay, appreciate y'all joining me as always. Thanks so much for being here. If you need help understanding valuations, if you're getting ripped off when you buy a stock, if you're getting a great deal when you buy a stock, if you need help understanding income statements, balance sheets, cash flows, anything like that, I have courses inside my private stock group. If you want access to those, pin comment down there, apply to join us in there, and yeah, get your game up. All right, much love and have a great day.